Okay, so we're going to have a look at today symmetrical triangles and how to trade symmetrical triangles, what they are, how they work, indicators that can help you, and how to profitably trade basically symmetrical triangles. So let's take a look at what they are. A symmetrical triangle is basically a consolidation or a contraction in price. So when price has made a move, what it will tend to do after that move is it will go into a consolidatory period or a contractive period. As you can see on the screen here, I've got some symmetrical triangles on the chart, and you can see basically they come in two different forms, either a bullish symmetrical triangle or a bearish symmetrical triangle. And basically the only difference between the two is where price has come from when the symmetrical triangle forms. So you can see here on the screen we've got a green symmetrical triangle, which is a bullish symmetrical triangle, and the reason that is a bullish one is because price has been moving up when the first point of the symmetrical triangle was formed. The red ones, you can see when they formed, the number one or the first point of the triangle is after price has made a down move. So because a triangle is either bullish or bearish, doesn't always necessarily mean that it will break either to the upside or to the downside. A symmetrical triangle can break in either direction, and the direction it tends to break in is usually dependent on how far price has moved and whether it's got more power to go further. So what you'll find is when you get price breakout in the direction of the symmetrical triangle's sort of indication, if you like, whether it's bullish or bearish, if it breaks in a bullish direction from a bullish symmetrical triangle, you tend to find that price moves fairly quickly and powerfully out of that triangle. If it breaks to the opposite side of the triangle, you'll quite often find that those moves are a little bit shorter or less powerful, and the reason for that is because those are typically pullbacks rather than continuations of the trend or continuations of the move that was put in before the symmetrical triangle was formed. So let's have a look at how you draw symmetrical triangles. So a symmetrical triangle consists of four main points. Let's zoom in and have a look at one here. Let's look at this little green one. So as you can see, what's happened is price has pushed up and then has turned in the opposite direction, put in a pullback. So when we see a pullback starting to happen, we class this as point one of the potential triangle. Then price pulls down and then it starts to retrace back the other way. That is point two. And then if price has pushed up to within a certain distance between points 1 and point 2, that is where we class point 3, and that is the turning point before it starts to drop again. And as you can see, as we drop again, we put in point 4 as price tends to push away. Point 5 I'll come on to in a little bit. That is your alert that a symmetrical triangle has formed or has completed. So let's take a look at how we measure symmetrical triangles. I've got on the screen here a standard zigzag indicator, which you can find anywhere on the internet in Google. There's loads of them available for MT4. And basically what the zigzag indicator does is identify new highs and new lows. So basically swing points. So we can use the zigzag indicator to easily find point 1 and point 2 of a symmetrical triangle. As you can see here, the red line is the zigzag indicator, and as price has pushed up and turned, that is where we measure point 1 and point 2 potentially of our symmetrical triangle. But in order to identify a pattern of a symmetrical triangle, we need a way to measure the distance of the contraction of the triangle. So a triangle needs to be 4 points, which are a trend line descending on the top and a trend line ascending on the bottom. So what we can do is use our good old Fibonacci tool. And if we put a measure from point 1 to point 2, we can use a Fibonacci retracement of a certain amount to measure to point 3. And then if we change our Fibonacci and put it from point 3 down to point 2, we can then measure to find point 4, and then the same from point 4 to point 3 to find our 0.5, and I'll come on to 0.5 in a moment. So that is how you can use a zigzag and a Fibonacci tool to create the measurements to find a symmetrical triangle. Now, it's a little bit obviously time consuming to look through your charts and find these manually. So there is an indicator available, which I'll come on to in a moment, which will automatically find these and draw them on the charts for you. And the way that you draw these and measure these can be different for different people. So the most common measurements used to find symmetrical triangle patterns are the 60 to 90% retracement on the Fibonacci. But if you wanted to, you can play around with these figures and use different ones to find different types of triangles. So the higher and the closer together these retracement levels are, the more accurate your triangles will be, but the less of them you will find. So the 60 to 90 is a good sort of midpoint for finding lots and lots of patterns. And you're probably not going to trade every symmetrical triangle pattern that you find, because some of them are just going to be drawn in long consolidation periods, which are not going to be tradable basically. They're just consolidations. But what we're looking for is symmetrical triangles after a strong move in one direction or the other. So you can play around with these settings and they will help you find different symmetrical triangle shapes or patterns, if you like. But the rules basically are, after we've got 0.1 and 0.2, price needs to have moved up a certain amount to find our 0.3, and then we measure from 0.3 to 0.2 to see if we find 0.4. And if price falls within these levels and does not exceed these levels, i.e. go over the 100% level, then we have a symmetrical triangle, and we simply draw a trend line from 0.1 to 0.3 and 0.2 to 0.4. And then once we have that in place, what we're looking for is for price to push away from 0.4 and retrace again to at least the 60% retracement level of our Fibonacci measurement. And this is where it starts to get interesting, because when we've got this retracement to 0.5, that signals to us that a symmetrical triangle is in place and we have further contraction happening, i.e. price has not just put in a 0.1, 2, 3, 4 and then moved up a little bit and collapsed out of it. It's pushed up, so price is getting tighter and tighter and tighter. And when we get a contraction like this appearing on the chart, what we tend to find is when price has picked a direction to break out of the triangle in, it tends to have an explosive move afterwards. And that is what we're looking to trade. So we can then put different levels or pending orders on our chart to take trades when price breaks out of the triangle in different ways. And we'll come on to profitable ways to trade symmetrical triangles a little bit later on in the video, and different ways to enter trades using symmetrical triangles. But for now, that is basically what a symmetrical triangle is, how a symmetrical triangle is drawn, and you can go and find these on your charts right now, and you can use the zigzag indicator to find your initial points 1 and 2 very easily. So let's take a quick look now at a much easier way to find these symmetrical triangle patterns. This is the symmetrical triangle pattern indicator. And as you can see on the chart, what it does is it draws the symmetrical triangles on automatically for you. So you don't have to worry about going and finding them yourself and doing the measurements and keeping track of your charts constantly. On the chart here, you can see that we've got the symmetrical triangle drawn in. It's also labeled the points for us and the alert, and it's even drawn in the Fibonacci levels automatically and the retracements here for you as well. And another cool feature of the indicator is it will also draw in targets for you. And I'll talk about targets when we look at the strategies to enter trades using symmetrical triangle patterns. So I'll quickly run through the indicator settings for you so you can have a look at what it does. So you can see here we've got a start candle for pattern search, and this is basically how many candles back you want the indicator to look for patterns for you. So this is really handy for back testing. So you could set this figure to say 10,000 or 20,000 or however many you want to, and go and look at all the patterns that have been drawn on the charts in the past, and you can see how you would have entered them and where price got to and how many times it would have hit the targets that you've set. So it's a really handy feature for back testing. The indicator doesn't repaint at all, so as soon as a symmetrical triangle is formed, it appears on your chart and it stays on your chart. You can change the Fibonacci max and min retracement levels. So this is basically these lines here, the 60 and the 90. So this is where we are retracing back to form our points of our triangle. You can play with these and set these to different figures, and you'll see how it affects the shape of the triangles. You can also use the indicator to draw ascending and descending triangle patterns as well if you wanted to, by just adjusting those figures. But play around with the settings if you want to. But as I say, the 60 to 90 level is what I found to be the most successful levels, and it draws the best sort of symmetrical triangles on the charts. You can set the indicator to also just show you the last signal. So if we set this to true, you'll see that all the other patterns on the chart will disappear. So we just have the one pattern. This is to keep your charts nice and clean. And we have other settings here for turning on or off the Fibonacci levels. So you could say that I don't want to see the Fibonacci levels, and that will just leave the triangles in place for you with the labels on them. And you can also have it so that it draws the Fibonacci extensions, which are the target levels, which as I said I'll discuss in a little bit, and that's the 161 level that we've got drawn on the chart there. So you can turn those on and off if you don't want them. You can turn on and off the number labels. You can adjust the size of the number labels. You can adjust the width of the triangle lines and the colors, and obviously we've got the alert system, so it will give you pop-up alerts as well as email alerts and push notifications should you so wish. The other settings we have in here are zigzag. So as I said in the previous part of the video, the zigzag indicator is really handy for finding highs and lows, so swing highs and swing lows in the market. And the indicator uses zigzag to identify points 1 and 2 to start doing its measurements from. So if you want to, you can also fine tune the zigzag. And the zigzag indicator, if you fine tune it to have larger numbers, will start to look for patterns which are much larger on the charts. So if you find that you're in a market or on a time frame where you're getting lots and lots of really tiny triangles forming, which aren't very reliable as signals a lot of the time, you can increase the zigzag settings so that it will start to use bigger triangles on lower time frames, and therefore it will give you more accurate entry signals. One thing to note with the zigzag indicator, which is noted on the indicator itself, is when you're fine-tuning zigzag, the back step, which is this setting here, cannot be equal to or exceed the depth of the indicator. If you do, the indicator will crash and zigzag crashes. This is just a glitch in zigzag. So just make sure that you keep this number, the depth number. If you change it maybe to 50, make sure you keep the back step number lower than that number. Okay. So that's the settings for the indicator. The indicator is available on the MQL5 marketplace. So you can go and get the indicator anytime you like. And obviously you can use it on any time frame and any instrument that you can trade within MT4. So if we switch down to another time frame, you'll see that it draws different triangles on your chart. So that's the indicator. So that will help you automate the drawing of symmetrical triangles. So now what we're going to do is we're going to look at how to trade symmetrical triangles profitably, and the entry and exit criteria we should be using and where we should be placing our stops. Okay, so we're going to use this triangle pattern as an example. So this is a fairly recent one that's been formed on the Aussie dollar, New Zealand dollar on the daily chart. And you can see obviously we've got a bullish symmetrical triangle formed here. So the first thing we need to do is we need to determine which way we're going to trade this. So being a bullish symmetrical triangle, we would typically expect these to break to the upside, because what we are expecting to happen here is a strong move to the upside, a consolidation and contraction of price, and then a continuation of that move. So at the moment, price is going up, so we would expect price to continue up. Now that obviously doesn't happen all the time. Sometimes these bullish symmetrical triangles will break to the downside, and what we will find is price has pushed up, consolidated, and then it starts either a reversal or a pullback. So we need to determine which way that we're going to trade these. Now, if you want to, you can trade just the bullish symmetrical triangles in that direction. So you would take long positions and trade just the bearish symmetrical triangles with short positions. The way I like to trade them is to assume that price is going to break effectively in one direction or the other with some kind of strength at some point. So the way that you would do that is you can enter a pending order when you get the symmetrical triangle alert, which is 0.5 here, in both directions. So the first way we're going to look at is basically assuming that we don't know which way price is going to go, because obviously we don't. And we are just going to take an entry when we get an aggressive move in one direction or the other. So there's two ways of doing this. The first way is that we can place a pending order. So what I would tend to do is place a pending order at 0.3 and a pending order at 0.4. And what we will do is we will place our stops on these orders at the opposing point. So what we're assuming is going to happen is price will either break aggressively to the upside, trigger our order on position 3, and we will make a profit on that one. Or it will break to the downside, trigger our order on number 4, and we will make a profit on that one. And obviously, if that scenario plays out, we will just cancel off the opposing order. So a buy stop on 3 and a sell stop on number 4. As you can see in this case, what would have happened in that scenario is we would have had our trade triggered and we would have gone into drawdown on it, and we're basically just sitting at the moment in a point of consolidation with one position on long. The danger with this method, obviously, is that you could have both of these orders triggered by price consolidating, and it will trigger number 3, come down and stop you out, trigger number 4, push back up and stop you out, and you will lose both of those trades. And that scenario does play out in some situations. So that is the danger of trading with this method. One way that you can combat that is, as soon as you get your trade triggered, you can then start to reduce the stop below the most recent lows. So in this case, as we triggered on number 3, we would have had our stop at number 4 initially. We could pull our stop up to an obvious low if there is a new low formed. And then we can trail that stop below the lows so that if price does come back, we get stopped out with a much smaller loss than we would have had initially. And then if price crashes through number 4 and collapses, we would make profit on that trade. So that's one way you can enter the positions. The other way is obviously when you get the alert, which is at 0.5 here from the indicator, you can take a long position immediately and assume that the symmetrical triangle, because it's bullish, is going to break to the upside and you're going to take a long position. This is more of an aggressive entry because we've not had any confirmation at this point that price has actually broken out of the symmetrical triangle. So obviously what price can do, and as it did in this case, is it can push up to the trend line that was formed and then pull back again and then push up again and obviously finally breaks. So this aggressive entry obviously is a more dangerous one, but as you can see, you will get a much tighter stop on your entry by taking that position. So with a tighter stop will come obviously more risk, but potentially much more reward if it does break aggressively to the upside. Another entry you can take is on a break of the trend line. So you can wait and monitor price, and as soon as you see it break above a trend line, you can take an entry. And you can either take an entry as it pushes above the trend line, or you can wait for a candle to close above the trend line, and then you would put your stop at the most recent low. So you can take trend line entries, and obviously the advantage of that entry method is that you are seeing price break out in one direction or the other. So although this is a bullish symmetrical triangle and we would expect it to break to the upside and continue the trend, if it decides to break to the downside, we can wait for that break of the trend line, and that is a confirmation that price is starting to move down. The disadvantage obviously of that is you can see we've got a low here and then a higher low, and as we break that trend line we're still only putting in a higher low, so there is potential for price to move up. We haven't had a break of market structure and a break of 0.4, so therefore that could just come down, break the symmetrical triangle and push up. We don't know, obviously, but as long as you've got a positive risk reward on every trade you take, i.e. if you take the break below the symmetrical triangle trend line here to the downside, you would put your stop just above these highs. As long as you've got a positive risk reward on the trade and you're using proper money management and risk, you're going to make a profit in the long run. So that is another way to enter the trades. One of my favorite ways to enter with symmetrical triangles is to wait for a pullback consolidation within the triangle after we've got our alert. So this one here is a prime example of the condition that I'm looking for. So we've got our initial entry possibility here. This is where we get our alert at 0.5. What I'm looking for is for price to then either pull back again within the symmetrical triangle and then push up, or to push up a little bit within the symmetrical triangle and then put in a pullback. This is more confirmation that we've got more contraction on the move, and it gives you a much tighter entry. So in this case here, for example, I would have taken my trade after this pullback and this bullish engulfing happened, and your entry would be on the close of this candle with a tiny little stop of 70 pips, and obviously a massive risk reward ratio on this particular trade. And obviously this could go all the way up to our targets up here, 161 extension in this case. So that's my favorite type of entry. So we've got our 4 points, we get our alert here. Price then either pulls back straight away and gives us some bullish price action, or it pushes up slightly but doesn't break out properly of the symmetrical triangle and then pulls back. Obviously with this type of entry, it's much more of a tight stop, therefore a better risk reward, but it's more manual entry because you've got to monitor price after you get the alert and see what happens. So there's your entry criteria. We can either set pending orders at points 3 and points 4 and get into those trades automatically with buy stops and sell stops. We can get in immediately when we get an entry. We can get in with a break of the trend line, or my favorite, we can get in when we get a pullback and then a positive move in the direction of the expected trend with a very small stop and a very high risk reward. So hopefully that's given you some ideas how you can trade symmetrical triangles. Go and have a look on your charts, look at the previous triangles and backtest. You'll be able to see where you could have got into those positions, where your stops would have been, and how far price moved outside of those symmetrical triangles and what type of risk reward you would have got. As I say, look for a positive risk reward, 1.2 or 1.5 to 1 at least, if not 2 to 1 or higher, and see how many of those trades would have played out and backtest it to see how you can trade them effectively and profitably. What we're going to do now is look at some examples of symmetrical triangles and patterns that have played out in the past, so we can see how we could have entered those and how we could have traded them. So we'll start off with this one that we can see here, which is a bullish symmetrical triangle. As you can see, price has had a strong up move. We've got the symmetrical triangle put in place, and we've got our alert on this candle here, which is 0.5. So in this particular case, you could have taken a trade as we broke through the upper trend line here, or you could have had a pending order on number 3 and number 4, and number 3 would have triggered. And obviously your risk reward on this one would have been 150 there, and you could have got 250 pips worth of profit out of that particular move. So there's one example of a bullish one and the two types of entries that you could have taken on that particular trade. Here we have another example of a bullish symmetrical triangle where we've had price pushing up, we've had the symmetrical triangle put into place, alert would have been triggered on this candle here. So price was pushed up into above the 60 level and then pulled back down. So in this case, we would have been looking for a break to the upside, and you would have had a break here. So you could have taken your trade there with your stop at 0.4, which is 280 pips away. And as you can see, price then consolidated for a while and then pushed up around about 240 pips. So this one wouldn't have quite given you a one-to-one risk reward, but it depends on how you're managing your trade. Obviously, this is on the daily chart, so you would have probably been moving your stop as you saw price moving up. So in this case, as we got the break above here, and we saw price pushing up in our favor up to here, we probably would have moved our stop from 0.4 under this recent low, which gives us a rough stop of around about 98 pips. In that case, then obviously what you can do is you can take a partial profit when you get to one-to-one, and then price would have pulled back down and taken you out either at break even or with a small stop. So there's another example of a breakout pattern. This one didn't quite work out and give us enough risk reward, but as you can see, it did hit the 161 target, which is the extension here of position 3 of 0.3. So we did get a target hit on it, but obviously the risk reward on this one would have been too high. So you'd have had to work out the best way to take this trade. If you'd have been waiting for the pullback scenario, where we get a push up, we don't really break out and close outside of the symmetrical triangle, and we have our pullback and our bullish engulfing candle, you could have taken a trade here with your stop under there. That one obviously would have been stopped out, and then as price pulled back down, you got another bullish engulfing within the symmetrical triangle there, and then a break above. So you could have either taken an entry on that bullish engulfing, or you could have taken an entry when we broke above the symmetrical triangle, which is probably the safer entry to take. Your stop would then be positioned there, about 85 pips, and obviously you would have profited on that move there of about 230. Here we've got an example of a bullish symmetrical triangle. So this symmetrical triangle here, where price has pushed up, and as you can see, we are within a larger bullish symmetrical triangle and a larger bearish symmetrical triangle at the same time. So that tells me that we're in a period of consolidation long term. But price has pushed up at the moment in the short term and pulled back to give us our symmetrical triangle pattern here. Here is our alert candle on number 5. And as you can see, price then broke out the symmetrical triangle to the upside. We could have triggered our order here on position 3 and our stop under position 4. And as you can see, price pulled back down in the other direction, stopped us out on position 3 entry on the buy stop we would have had here. It would have triggered our sell stop, and then obviously pushed way down to the downside. So this is a good example of the pending order strategy for getting in off symmetrical triangles playing out perfectly. So we had an entry at number 3, which was a failed entry and stopped out, and an entry at number 4, which was successful. And as long as we've got a positive risk reward, entry number 4 would have made more profit than the loss on entry 3, and we make money. Here we have two nice examples of a bullish and a bearish symmetrical triangle playing out. So on the left hand side here, we've got a bullish and a bearish symmetrical triangle very, very close to each other. This bullish symmetrical triangle, we had a break to the upside, obviously broke above 0.3 and then shot off in the expected direction. This bearish symmetrical triangle is a much smaller one, which was painted within this larger bullish symmetrical triangle. But as you can see, this one never actually broke to the downside, it broke to the upside. So whichever of these you'd have taken on the break, you would have made profit on. And here we have a bearish symmetrical triangle painted on the chart here. This is more of a consolidation. So we have had a price push to the downside, but obviously we're on a very low time frame here on M15. And like with any strategy or any trading method, the lower the time frame, the more signals you're going to get, but the more failed signals you're going to get, because you're trading much more choppy market conditions. So trading higher time frames, hourly, 4 hourly and daily with symmetrical triangles is going to be much more successful and profitable than trading lower time frames is going to be. But this bearish symmetrical triangle, as you can see, played out fairly nicely. We had a push down, a push back up again, and then we contracted in the triangle. Position 0.5 is where you would have got your signal, so you could have entered directly there with a stop at 0.4, which is 10 pips, and then price pushed down 17 pips and obviously hit the 161 extension target there. You could have also taken the break of the triangle, which would have given you a slightly larger stop, but still profitable. So both of those played out very, very nicely. We've also, within this symmetrical triangle, got the other entry method I discussed, which is where we get the alert and then price pulls back within the symmetrical triangle and gives you a bearish price action. So in this case, you would have got in exactly the same point as if you'd have entered on 0.5 on the alert. But as price pulled back and then pulled back down again, that could have been where your entry was. And obviously that one, you would have had a very, very small, tiny 4 pip stop on it and a much, much, much bigger risk reward. Obviously they're more dangerous entries to take, much more aggressive entries to take, but they will give you a much bigger risk reward ratio than waiting for a break of 3 or a break of the trend line. Here we've got 3 really nice entries on the hourly time frame on Euro US dollar. As you can see, we had a big price move down and then we had a nice contraction of price put in here. And as you can see, we got our alert on 0.5 here, and if you'd have taken that one, you would have had roughly a 60 pip stop, and the target on it was around about 66, but it pushed all the way down to 186 pips to the downside. You could have taken the entry on the break of the trend line, and as you can see with this one, we didn't get any type of contraction or pullback, it just collapsed straight away outside of the triangle. Then as price pushed back down, we got a new symmetrical triangle painted at the bottom here. And this is a great example of a reversal symmetrical triangle. So as we've had a push down on this one, and then a second leg push down on the trend, we've got to the point where price wanted to reverse. So we can see that we got the symmetrical triangle, very nice, small, compact one. We broke out to the upside of it in the opposite direction to what we were expecting, and price never really looked back and just disappeared all the way to the upside there. So depending on how you entered on this one, if you got in on 0.5, you would have been in there somewhere with a very nice risk reward ratio. If you'd have taken a partial profit and held the rest, you would have made an awful lot more on this trade, obviously. But as you can see, price pulled back down, never would have got close to stopping you out before pushing off in that direction again if you were to hold it for longer. As we pushed up, we then got a pause in price where we went into a consolidation and a contraction, new symmetrical triangle painted. This one, we had an entry on 0.5, which was here. So if you'd have taken your initial entry and stopped under 0.4, you would have got stopped out in that position, but you could have taken another entry when we broke above the trend line, which is also a break above 0.3 here. And then obviously price went off to the upside. So with this particular example, if you'd have placed pending orders at 0.4 and at 0.3, obviously what would have happened is you would have got entered on 0.4 as price pushed down and then stopped out on that position, and then you would have entered automatically on 0.3, and that is the trade that would have made the profit for you. 2 more good examples here on the pound Swiss on the hourly chart. As you can see, we had price which is in a consolidation. We did have a push up and then a pullback and a very, very tight symmetrical triangle formed. It never broke the upside or closed outside of the upside on this one, and then it pulled back. You would have got entered on potentially position 4 there and then stopped out on position 3 where your stop would have been. But if you'd have had your pending order on 0.3, that one would have worked and made you a very nice profit. We pushed up and then got to another symmetrical triangle formed with a contraction, and then that one broke out. The alert was actually on the break of the symmetrical triangle in this case on number 5, so you would have taken that immediately, stopped below number 4, which was 40 odd pips, and then we had a good 100 pip, 120 odd pip move to the upside on that one. Here's some nice examples of trades on the 4-hour chart on New Zealand dollar yen. So we had a push up, strong push up to the upside on this one, and then a pullback and contraction. The alert was on 0.5 here, which closed outside of the symmetrical triangle in this case. You would have entered there, your stop under position 4, which you would have got potentially stopped out on. It was very, very close on that one as to whether that would have been a stop out or not. And then price pushed off to the upside. If you'd have taken an entry with pending orders on 0.4 and on 0.3, you would have got entered on the 0.4 entry to the sell side and then stopped out as it pushed up, but you would have got in on 0.3 and you would have never had anywhere near your stop. This one just went straight off to the moon, so that would have been a nice profitable trade from 0.3 on that one. We have another entry here. We have a bullish symmetrical triangle, but again, as you can see, this one's been formed after quite a lot of consolidation, so quite often these aren't the best trades to take, but in this case this one played out very nicely. So we had a push up and a pullback and then a contraction in there, and price broke out. 0.5 was here. You could have taken your entry there with a stop below 0.4, which is 50 odd pips and a 200 pip move, or you could have taken the entry on the break or on 0.3. All three of those positions, all three of those entries in this case, would have been successful and given you a very, very nice profit. And as you can see, we had more symmetrical triangles formed here. We had a bearish symmetrical triangle formed and a bullish symmetrical triangle formed. And you can see they're very, very, very close, similar triangle patterns here. So when you get that kind of scenario forming, it tends to be more of a consolidatory period. And you would play both of these in exactly the same way. So you would set your entries, you would have been alerted on this one, in this case, obviously there on the bearish and there on the bullish. So you'd have had two alerts, and you could have taken 0.4 entry and a 0.5 entry. Obviously, the only one that would have triggered, sorry, a 0.4 entry and a 0.3 entry. The only one that would have triggered for both of those symmetrical triangles would have been your entry on 0.3 there. And obviously that one is played out fairly nicely, would have made a nice profit as well. Here's a nice example on the US dollar CAD on the daily chart. So we've had a symmetrical triangle form here. And as you can see, 0.4 has been put in, and then 0.5 has alerted as we've broken the 60 level right on that candle there. Entry, if you're aggressive, is going to be on the alert with your stop about 280 odd pips under 0.4. It went straight away, broke out the symmetrical triangle. That would have been a second entry for you, and a third entry when a break of 0.3. And obviously you can see this one just shot off straight to the moon. So lovely symmetrical triangle break. Never in any danger whatsoever of getting into any type of real drawdown on this or anywhere near a stop out. We also have our pullback entry here as well. So we had our price break above the 60 level to give us 0.5 and give us our alert. Price then pulled back and gave us a bullish engulfing candle. Again, that broke 0.5. So you could have taken an entry here on this one with your stop very, very tight, only 100 odd pips underneath that candle, and massive, massive risk reward there. Here we've got a good example of a bearish symmetrical triangle which was formed, obviously on this down move here. Pull up, we've got contraction. Our alert would have been given here. It never pushed down and broke below level 3 and pushed up and then broke above level 4. So you would have taken an entry potentially long on this one. You may have taken a short entry. Obviously, if you've got your aggressive entry, you would have taken an entry on 0.5 and that one would have been stopped out. But you could have taken a break then above the top trend line on multiple occasions, and this one obviously then moved to the upside. So you would have got in with a good 480 odd pips there. So 1-to-1 if you were using the low there, but if you're using a more aggressive entry and a closer stop, you would have been a good positive sort of 2-to-1 risk reward on that trade. Straight after this bearish one failed and turned into a reversal break, we had a bullish symmetrical triangle form, but again, this is more of a consolidation. I prefer to see triangles forming after a strong move rather than in a consolidation, but you could have taken this one as well. Entry was on 0.5 there, stop under there, 250 pips with a 527 pip move to the upside. You could have taken the break here, which would have been the break of the triangle, and the break of 0.3 as well. That one just sat and consolidated and then pushed off as well.